Learn to Earn, A Beginner's Guide to the Basics of Investing in Business, by Peter Lynch and John Rothschild. Introduction. Imagine two young people, both about your age. Let's call them Joe and Sally. They both live at home with their parents, and they both land their first real job working at the local Walmart. They're excited, earning their own money for the first time. Joe, like a lot of us, has a dream. He sees a brand new Camaro in a showroom, glistening under the lights. It's cool. It's fast. He saves every dollar he can, puts $2,000 down, and signs up for a 5-year car loan. For the first few months, it feels incredible. He's the king of the road. But soon, the new car smell fades. A few scratches appear on the door. And every single month, $400 flies out of his bank account to the finance company. After 5 years, he's paid $26,000 for a car that's now worth maybe $5,000. He's sick of it, and he's no richer than when he started. Now let's look at Sally. Sally works just a few feet away from Joe at the same Walmart. She also saves up $2,000. But instead of buying the flashy new car, she buys a simple, used Ford Escort for cash. It gets her from point A to point B. Since she has no car payments, she takes that $400 Joe is sending to the bank each month, and she invests it. She puts it into a stock mutual fund. 5 years go by. Joe makes his final car payment, and he has nothing to show for it but an old car he doesn't even like anymore. Sally, on the other hand, her investment has been quietly working for her. Compounding. Growing. After 5 years, her mutual fund is worth nearly $30,000. Enough for a down payment on her own house. This simple story isn't just about cars. It's about a fundamental choice we all face. It's the choice between being a consumer and being an owner. And it's the central lesson from one of the most important and accessible books ever written on finance, Learn to Earn, by the legendary investor Peter Lynch. Peter Lynch is a giant in the world of investing. As the manager of the Fidelity Magellan Fund, he took a small fund and grew it into a $14 billion behemoth, achieving an average annual return of over 29% for 13 years. To put that in perspective, it's a record that has rarely, if ever, been matched. But Lynch's greatest gift isn't his ability to pick stocks, it's his ability to explain the world of business and investing with such simple, profound clarity that anyone can understand it. He wrote this book because he believes that the most important subject is almost never taught in our schools: how money, business, and investing actually work. So, for the next little while, I want to be your guide through his timeless wisdom. My promise to you is this: by the end of our time together, you will no longer see the world as just a collection of stores, products, and brands. You will see it through the eyes of an investor, as a world of opportunities, a world where you don't just have to spend money, but you can put your money to work for you. You'll understand the epic story of how this system was built, and more importantly, how you can become a part of it. Book summary. Let's begin right where you are. This morning. From the moment you woke up, you've been surrounded. You may not have realized it, but you've been walking through a world built, owned, and operated by thousands of invisible partners. The clock radio that woke you up? It might have been made by General Electric. The sheets on your bed? Maybe from a company called West Point Stevens. The toilet? The sink? The faucets? Perhaps American Standard. The toothpaste and shampoo you used? Almost certainly from Procter & Gamble. The razor from Gillette, the underwear from Fruit of the Loom. You haven't even had breakfast yet, and you're already involved with a half-dozen public companies. At the breakfast table, the Cheerios are from General Mills. The Pop-Tarts from Kellogg's. The orange juice might be Tropicana, which is owned by PepsiCo. You see, these companies are everywhere. The bus you ride to school is likely made by General Motors, with tires from Goodyear, running on gasoline from Exxon or Texaco. The books in your backpack are published by companies like Simon & Schuster or McGraw-Hill. Nearly everything you eat, wear, read, listen to, or ride in is made by a public company. And this brings us to the first, and perhaps most powerful idea that Peter Lynch wants us to understand. A public company is one of the most democratic institutions in the world. What does that mean? Well, if you go to your local barbershop or a family-owned restaurant and you love the way they do business, you can't just walk in and become an owner. That's a private company. But if you're impressed with the service at a Hilton hotel, or you see a line of people waiting to buy the new iPhone, or you just love your Nike sneakers, you can become an owner. Any company that sells shares of its business in the stock market is called a public company. And it doesn't matter who you are, what your background is, or how much money you have. If you can afford even one single share, you can become a part owner of Nike, or Apple, or McDonald's. The chairman of the board can't stop you. It's an example of true equal opportunity. When you buy a share of stock, you are buying a tiny piece of that business. That piece of paper, or more likely today, that digital entry in an account, is a certificate of ownership. It has real value. And when the company succeeds, when it sells more products and makes more money, your little piece of the business becomes more valuable. The profits, in some small way, flow back to you. This is the very heart of the system we call capitalism. It's a word that gets thrown around a lot, sometimes with confusion or suspicion. But at its core, Lynch explains, it's a very simple and beautiful mechanism. Investors, people like you and me, provide the money, or the capital, that allows a company to grow. The company uses that money to build new factories, open new stores, or invent new products. This creates jobs. More jobs mean more people have money to spend, and some of that money they can save and invest, starting the whole wonderful cycle all over again. Investors, Lynch says, are the first link in the capitalist chain. But how did we get here? How did this world of corporations, stocks, and public ownership come to be? This isn't just a dry history lesson. It's the story of a radical idea that changed the world. For most of human history, the average person owned nothing. People worked as serfs or slaves for kings and lords who owned all the land, all the buildings, everything. There were no paychecks because there was nowhere to spend money. The idea of getting ahead in life didn't even exist. Your station in life was fixed from birth. The first whispers of change came from a curious place, a bridge over the Amstel River in Amsterdam. As far back as 1602, ordinary Dutch people were gathering on this bridge, pushing and shoving to buy something new and extraordinary, shares in a company called the United Dutch East India Company. This was the world's first popular stock, sold on the world's first stock exchange. The company used the money from these investors to outfit ships and sail to the Far East, bringing back spices and goods that were all the rage in Europe. The company was a success, the stock price doubled, and the shareholders were rewarded with regular payments called dividends. Capitalism was born. This idea, of pooling money from many people to finance a big venture, is what fueled the exploration of the New World. You see, the history books tell us about explorers and pilgrims, but they often leave out the most important detail: someone had to pay for the ships. When the pilgrims landed at Plymouth Rock, they were actually trespassing on land owned by an English company. And their entire journey was financed by a group of investors in London who called themselves the Adventurers. These investors made a deal with the pilgrims: we'll pay for your trip to America, and in return, you work for 7 years to make the colony profitable. At the end, we'll split the profits. It's a fascinating story. The deal almost fell apart. The investors got greedy and changed the terms, demanding the pilgrims work 6 days a week instead of 4. The pilgrims, feeling cheated, set sail without a signed contract. Their first ship, the Speedwell, leaked and had to turn back. They crowded onto the smaller, slower Mayflower and got blown off course, landing in Massachusetts instead of Virginia. From a business perspective, the Plymouth colony was a disaster. For years, it lost money. The investors back in London were furious. They were getting zero return on their investment. Finally, in 1627, the exasperated investors sold the entire operation to the Pilgrims themselves for 1,800 British pounds, which the Pilgrims had to pay off on an installment plan. This, Lynch points out, was the first leveraged buyout in American history, workers taking over the company with borrowed money. The story of the Pilgrims teaches us a timeless lesson about human nature. At first, they decided to live communistically. They pooled all their resources, and no individual was allowed to own private property. Governor William Bradford saw immediately that this would fail. Why? Because there was no incentive. A person who worked hard received the same benefits as a person who did nothing. He realized that a person who owns property, who has a personal stake in the outcome, is likely to work much harder. So they changed the system, allowing people to own their own farms and boats and to profit from their efforts. That free enterprise system is the foundation of the one we have today. The idea of selling shares to the public caught on slowly and sometimes disastrously. In the early 1700s, bubbles of frantic, foolish investing formed and burst. In France, a charismatic schemer named John Law launched the Mississippi Company, convincing the public that Louisiana was filled with gold. Hysterical Parisians threw their life savings at the stock, whose price soared to absurd heights before collapsing, wiping out fortunes and ruining the French economy. A similar mania happened in London with the South Sea Company. The stock market got such a bad name that Parliament actually made it illegal to buy or sell shares. But the idea was too powerful to be suppressed. In America, after the Revolution, pioneers of finance like Alexander Hamilton realized that for the new country to grow, it needed banks and a financial system. Companies were formed to build bridges and turnpikes, funded by selling shares to the public. These were the ancestors of the great railroad, canal, and industrial companies that would transform the nation. The 19th century was the age of American invention. The steamboat, the cotton gin, the reaper. But these inventions would have stayed on the drawing board without capitalism. It took investors, willing to risk their money, to build the factories that manufactured these new machines. And this leads us to another crucial idea, the invisible hand, a concept from the great economist Adam Smith. Smith argued that when millions of individuals are free to pursue their own work, to make and sell what they please, society as a whole is far better off. You don't need a king or a central planner telling everyone what to do. The market sorts it out automatically. If too many people decide to make hats, the supply of hats goes up, and the price comes down. Some hat makers will then switch to a more profitable business, like growing vegetables. This invisible hand keeps the supply and demand of everything in balance. This competition is incredibly good for us, the consumers. It forces companies to constantly improve their products and lower their prices. It's why every few months, a new computer comes out that's more powerful and less expensive than the old one. As America grew, so did its companies. National brands that we still know today emerged: Campbell's Soup, Heinz Ketchup, Wrigley's Gum, Levi's Jeans. And with them came the rise of powerful, sometimes ruthless, industrialists known as the robber barons, men like Andrew Carnegie, Cornelius Vanderbilt, and John D. Rockefeller. They built vast empires in steel, shipping, and oil. This led to one of the greatest dangers a capitalist system can face: monopoly. A monopoly is when one company, or a small group of companies, controls an entire industry. Think about the board game Monopoly. The goal is to own all the properties so you can charge outrageous rents to anyone who lands on them. In the real world, a monopoly is the same. If one company controls all the oil, it can set the price as high as it wants, and customers have no choice but to pay. Competition, the very engine of capitalism, was being destroyed. Rockefeller formed the Standard Oil Trust, which controlled 90% of the oil refineries in the U.S. There was a sugar trust, a whiskey trust, a tobacco trust. It was a scary time. It seemed as if economic freedom was being lost to a handful of powerful insiders. But the American people fought back. Journalists called muckrakers exposed the abuses. And courageous political leaders like President Teddy Roosevelt became trust busters, using new antitrust laws to break up these giant monopolies. Standard Oil was broken into smaller, competing companies that we know today as Exxon, Chevron, and Mobil. Later, in our own time, the same thing happened to Atant, the phone monopoly. Its breakup led to more competition and cheaper phone calls for all of us. This is the system correcting itself, preserving the competition that keeps it healthy and fair. So this grand, chaotic, and ultimately triumphant story brings us to today. A world with thousands of public companies, regulated markets, and the opportunity for anyone to become an owner. Now, you might be thinking, this is fascinating, but I'm not a history student. I want to know how to make money. And this is where we turn from the past to your future. Lynch's most urgent piece of advice is simple: start now. The single greatest asset any investor can have is not a high IQ, not a fancy degree, not even a lot of money. It is time. Let's revisit our friends Chris and Pat from an illustration in the book. Chris starts investing early, at age 18, with just a $2,000 initial investment. He continues to invest a portion of his income regularly. Pat, on the other hand, waits until he's 40 to start investing. Even though Pat invests a much larger amount of money each year, more than double what Chris does, by age 65, they both end up with the same amount, a little over $900,000. How is this possible? The magic of compounding. When your money earns interest or grows in value, that new money also starts to earn money. It's like a snowball rolling downhill. The longer it rolls, the bigger it gets. Chris gave his snowball a 22-year head start. That head start was so powerful that Pat, even by throwing much more snow at his own snowball later on, could never catch up. The phrase "time is money" should be rewritten. Time makes money. So, where should you put this money you're saving? Lynch walks us through the 5 basic options. First, there are savings accounts, money market funds, and CDs. These are safe. Your money is usually insured. But their big disadvantage is that they pay a very low rate of interest. Often, the interest they pay doesn't even keep up with something called inflation. Inflation is just a fancy word for prices going up. If you're earning 2% interest in a savings account, but prices are rising by 3%, you are actually losing buying power. Your money is on a treadmill that's slowly moving backward. Second, there are collectibles. Things like stamps, coins, or baseball cards. This is a very specialized business. You have to be an expert. And collectibles can be lost, stolen, or damaged. Also, and this is a crucial lesson, buying a new car is not an investment. It loses value the second you drive it off the lot. Third, there is buying a house. For most people, this is the best investment they will ever make. You can live in it, and you typically buy it with borrowed money from a bank, which magnifies your returns. Fourth, there are bonds. When you buy a bond, you're not an owner, you're a lender. You are loaning your money to a company or a government for a set period of time, and they promise to pay you a fixed rate of interest. Bonds are safer than stocks. If you buy a McDonald's bond, the company is legally obligated to pay you back. But there's a trade-off. If McDonald's has a fantastic year, the stockholders, the owners, will see their shares go up in value. The bondholders get nothing extra. They just get their interest. Over the long run, bonds have provided a much lower return than stocks. And this brings us to the fifth and, in Lynch's view, the best option for long-term growth: stocks. When you buy a stock, you are buying a piece of a business. If the company prospers, you share in that prosperity. History is very clear on this. Over many decades, stocks have outperformed all other types of investments. But what about the risk? What about the crashes? This is the fear that keeps so many people away from the stock market. The ghost of the great crash of 1929 still haunts us. Lynch confronts this fear head-on. Yes, the market has corrections. That's a drop of 10% or more. It also has bigger drops called bear markets. These are unavoidable. In a 50-year investing life, you can expect to live through 8 or 9 of them. The critical mistake people make is trying to anticipate these downturns. They sell their stocks, hoping to avoid the crash, and then wait for things to calm down before they get back in. Lynch says that far more money has been lost by investors trying to anticipate corrections than has been lost in all the corrections combined. Why? Because the market's best days often happen very close to its worst days. During one 5-year period in the 1980s, the stock market gained an incredible 26% per year. But most of those gains occurred on just 40 days out of more than 1,200 trading days. If you were out of the market on those 40 key days, your return dropped from 26% to a measly 4%. You would have been better off in a savings account. The lesson is clear: you can't time the market. The secret is to invest for the long term and stay invested. Your discipline, your patience, and your courage to hold on through the bad times are more important than your brainpower. So, how do you get started? Lynch presents 2 paths. The first, and the easiest for a beginner, is through mutual funds. A mutual fund is a simple but brilliant idea. A fund manager collects money from thousands of investors, big and small, and invests that pile of money in dozens, or even hundreds, of different companies. When you invest in a mutual fund, you automatically become a part owner of all the companies in the fund. This is much less risky than putting all your money into a single stock. You can often start with as little as $100 and add more whenever you can. Lynch offers some timeless advice on picking funds. If you're a long-term investor, he says, ignore the bond funds and go for pure stock funds. Look for funds with a long, consistent track record of success. And consider a special type of fund called an index fund. An index fund doesn't try to beat the market, it simply buys all the stocks in a particular index, like the S&P 500. It runs on automatic pilot, with very low fees. Over time, index funds have performed better than the majority of actively managed funds whose managers are paid big salaries to try, and often fail, to beat the average. The second path is more of an adventure, picking your own stocks. This takes more work, but it can be incredibly rewarding, both financially and intellectually. This is where Lynch's most famous principle comes into play: invest in what you know. This is your edge as an amateur investor. The professionals on Wall Street, for all their fancy computers and degrees, can sometimes overlook the obvious. You have first-hand knowledge from your own life. Do you work at a store in the mall? You have a front row seat. You can see which stores are always crowded and which are empty. You can see which ones have happy employees and customers who love the merchandise. The employees at the Gap or McDonald's could have seen for themselves how successful those businesses were long before Wall Street caught on. Your experience as a consumer is a powerful research tool. Did you just buy a product that you love, that seems better than all its competitors? Find out who makes it. Is it a public company? That's the beginning of your research. But a great product is not enough. You have to understand the company's story. The story, Lynch explains, tells you what's happening inside a company that will produce profits in the future. Is the company growing its earnings? Earnings are the profits left over after all the bills are paid. In the long run, a company's stock price will always follow its earnings. If earnings go up, the stock price will eventually follow. If earnings go down, the stock price will go down. It's that simple. Lynch gives a fantastic example with Nike in the late 1980s. The company had hit a rough patch. Sales and earnings were declining. The stock price fell. But then, if you were a shareholder and you were reading the quarterly reports the company mailed to you, you would have seen a change. In the fourth quarter report of 1987, the tide had turned. Sales were picking up. Future orders were up. Earnings were improving. The story was getting better. Just as this good news came out, the stock market crashed in October 1987. Panic was everywhere. People who confused the stock price with the story sold everything, including their Nike shares. But an investor who was following the story would have seen this as a golden opportunity. The company was getting stronger, but the crash had made its stock cheap. You could buy more shares at a bargain price. Those who did were rewarded handsomely. Over the next 5 years, Nike's stock became a 12-bagger, meaning it went up 12 times in value. This brings us to the life of a company. Lynch beautifully personifies businesses, giving them a life cycle just like a human. It starts with the birth, an idea, often in a garage. Think of Steve Jobs and Steve Wozniak building the first Apple computer. In the early days, money comes from the founder's own pockets, or from a rich uncle or friend, an angel. As the company grows, it needs more money, and it turns to venture capitalists. Then comes the big day, the initial public offering, or IPO. The company sells shares to the public for the first time. It now has the money to reach its full potential. Next is the company's youth. It's full of energy and growing fast. This is where you can find those explosive 10-baggers. But it's also a risky stage. Many young companies fail. Then comes middle age. The company is more stable and reliable, but its growth slows down. It might even have a midlife crisis, where it has to reinvent itself to stay competitive, just as Apple did in the 1980s when it faced a challenge from IBM. Finally, there is old age. Companies like U.S. Steel or General Motors have put their best growth years behind them. They may still be profitable and pay dividends, but they are no longer the spectacular performers they once were. Lynch reminds us that no company stays on top forever. Being a blue chip doesn't save a company whose time has passed. Throughout this life cycle, companies are constantly interacting. Sometimes, one company will buy another. This is called a takeover or a merger. Philip Morris, the cigarette company, bought Kraft to get into the cheese business. This is how industries consolidate and evolve. The world of business is a dynamic, living ecosystem. And in this ecosystem, there are heroes. Lynch believes we don't celebrate our business heroes enough. We celebrate athletes and movie stars, but what about the people who build companies that create thousands of jobs and invent products that change our lives? Lee Iacocca saved Chrysler from bankruptcy, saving the jobs of over 100,000 workers and hundreds of thousands more at the companies that supplied Chrysler with parts. Fred Smith, who got a C on a college paper outlining his idea, created Federal Express, revolutionizing how we ship packages. Bill Gates and Paul Allen, a couple of college dropouts, started Microsoft in a garage and created the software that powers most of the world's computers. Bernard Marcus and Arthur Blank, two executives who were fired from a hardware store, decided to start their own, and called it Home Depot. Ben Cohen and Jerry Greenfield, two hippies, took a $5 mail-order course on how to make ice cream and built Ben & Jerry's. These stories aren't just from the past. Every year, new companies are born, and new heroes emerge. America, Lynch reminds us, is still the land of opportunity, a place where smart, hard-working people can come from modest backgrounds and build something extraordinary. And the best part is, you don't have to be one of these heroes to benefit from their success. You just have to be a shareholder. You can own a piece of their dream. Commentary. As we step back and look at the world that Peter Lynch has painted for us, what strikes me most is its profound optimism and its radical simplicity. In a field that often seems designed to be intimidating, filled with jargon and complex charts, Lynch throws open the doors and says, "Come on in. You belong here. You can do this." The most powerful lesson in Learn to Earn is not a secret formula for picking stocks. It's a shift in mindset. It's the realization that you are already an expert in your own life. You are surrounded every day by businesses. You interact with them, you use their products, you see what works and what doesn't. That personal experience is not trivial. It is a powerful source of investment ideas. Lynch empowers the individual. He tells you to trust your own common sense over the hot tips and the noise from Wall Street. This book is a beautiful counter-narrative to the idea that capitalism is a rigged game for the rich. Lynch shows it as a dynamic and democratic system where anyone, with a little bit of savings and a lot of patience, can become an owner. He celebrates the creators, the builders, the entrepreneurs who take an idea from a garage to a global enterprise, creating jobs and prosperity along the way. He reminds us that profit is not a dirty word. It is the fuel for growth and innovation. So, what can you do with this knowledge right now? Let me offer a few simple, practical steps. First, start seeing the world through an investor's eyes. The next time you're at the mall, or the grocery store, or just browsing online, pay attention. What products do you love? What stores are always packed? Start making a list. This is the beginning of your research. Second, start a paper portfolio. You don't need real money to begin. Just take an imaginary $10,000 and pick 5 companies you know and like. Write down their stock prices. Follow them for a few months in the business section of the newspaper or online. See how they do. This is your flight simulator. You can learn from your mistakes without risking a dime. And third, have a conversation. Talk to your parents or a trusted adult about what you've learned. Ask them about their own experiences with saving and investing. Perhaps you can explore the idea of opening a custodial account, where they can help you invest a small amount of money from a part-time job or birthday gifts. The journey of 1,000 miles begins with a single step. This book is that first step. It is a map and a compass for a world that might seem foreign but is, in fact, all around you. It's a world of opportunity, waiting for you to claim your stake. That was a summary of Learn to Earn by Peter Lynch and John Rothschild. We've touched on the big ideas today, but I'll be honest with you, a summary is like looking at a photograph of the Grand Canyon. A book like this is about standing on the edge of it yourself. The real magic happens in the quiet moments of reading, when a particular story or a simple phrase connects with your own life in a way you didn't expect. This summary is a starting point, a way for you to decide if this journey is right for you. If anything we've talked about today has sparked your curiosity, I encourage you to pick up a copy. Reading it isn't just about learning, it's an experience that can genuinely change the way you see the world and your place in it. You can find a link to the book in the description below. Also, if you found this summary valuable, please take a moment to like this video and subscribe to the channel. It lets me know that this work is helping you, and it ensures you won't miss our next exploration of another life-changing book. Let's keep learning and growing together.